Hey everybody, Signet here with the OEC. I, I don't think I've got enough videos on gap, so I'm going to do another one. I have started using the phrase gap resolution. It's the first thing that the market does in the morning is it resolves the gap. Now I've had some questions on this because it doesn't really fit into the other videos that I've done. What is this perspective that I'm talking about? What is this resolution of the gap? Well, when we start to break the day down into zones of time, we need to understand that the first thing the market does is it opens up. Dun, 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 dun. Thanks, Captain Obvious. Now, after the market opens up, we are looking for it to resolve the gap. Did the market move last night? And of course, we're talking about futures, so we know that it did. Is it going to open above or below where it closed the night before? When it opens below where it had previously closed, we expect the market to move up because we're expecting it to close the gap. Now, whether the gap gets closed or not, the market will resolve the gap, meaning it's either going to get to its destination and close the gap, or it's going to shrug its shoulders, give up, and it's going to continue to do what it was originally going to do for the day. Okay, so it will resolve it one way or another. It will either do it, it'll do the darn thing, or it won't. And when that has been decided, then we start looking at the next zone, which would be open range. Now, here's a great example of that yellow line that you see. That is Globex open. I use that just to see where the market closed. They're not always perfect, and I tried to code an indicator that did show market close, and it oftentimes overlapped with that. There was no reason to use my coded indicator, so I went ahead and threw it out, and I just use Thinkorswim's indicator called Daily Open. It's good enough. It catches the Globex open, and that is basically where the market closed the night before, the day before. Okay, so here we are, we're looking at a market that opened up below where it closed. The first thing we would anticipate is a market closing the gap. It started to make the run, but it stopped. It stopped trying to fill the gap right there, and it gave us an open range. So the gap was resolved. Now you can see that later on in the morning, it did eventually get up there and it did close the gap. But we're looking for gap resolution, the very first thing. And when this turned and pivoted in the other direction and gave us a low, we then had an open range. We can't get to an open range until we've resolved the gap. So when this gave us an open range, the gap was resolved. We know it was resolved as soon as it pivoted and began running hard the other direction, all the way back down to where the market opened. At that point, we knew we were not going to get anything else for the gap at that point. We were on to the next zone, and the next zone would be open range. Now, we did eventually close the gap, and we also had a Busby take us down to the top of the open range as we broke through the gap, right? So we had a lot of moving parts here on this market all at once, a lot of different things going on. But when the bell rang and the start of the day began, the very first thing we would have been anticipating was a market moving to the upside to close this gap. So now you've got a better understanding of what I mean by gap resolution. It is the first thing that the market does. If it doesn't close the gap, it resolves it. And we know it's resolved because it pulled back and it gave us a low for our open range to be here. We could not have an open range unless we had resolved the gap. So let's take another example. I'll just scroll back and look at another day. So here we are again, way below the open, right? Not way, way below, but we're below the open or the close. The close is that yellow line. The market opens, and the first thing that it wants to do is try to close that gap. Now, it didn't get very far at all. You can see that from the place it opened to the place that it turned around was not very far. It resolved the gap very quickly, and it indicated very quickly that it was not interested in closing the gap at all. At that point, in the very next candle, we had full confirmation that this thing was not interested in closing the gap, and now we're looking for open range, which would be that candle right there, because that's where the market pivoted and gave us a low. If we take that across the chart, you can see that the open range played out perfectly. We had a market that broke down through the bottom of it, came back through and tested it, couldn't hold, tried it again and again. You see how that open range is working out perfectly, letting us know or giving us a hint or an indication where could the market react to something. It could react right here. We can see it very clearly. And if I push this forward another day, there we go. So as I just scroll through here, look at how many times the market got to that level and reacted when it got there. Okay, sure, it broke through this right here, and that was a Fibonacci pullback, and it still stopped at structure. It let us know there would be no open range, no close of the gap, right? Could it later on? Oh yeah, absolutely. It could have came back down here and fiddled around for a while and broke up and gone and closed the gap. Sure it could, but we're looking first thing in the morning. What is the market going to do? It's going to try to close that gap. Did it make it, or did it give up and give us an open range? It failed, and it gave us an open range, and that open range gave us the morning, and we could have been looking for our afternoon trade. So let's take another look. Let's find another example. We'll just move across the screen here. Aha, here we opened above the market. The gap went to the upside. So that yellow line is below us. The first thing we are looking for here, did the market close the gap? This yellow line is our target. The market opened up and he hauled around. It did not immediately start moving to close that gap. There would be no gap close in the morning session that quickly. We're done with the morning gap at that point. It has been resolved, right? Because we're looking at the next thing, which would be our open range. From there to there, it gave us a pivot high and it gave us a pivot low. We have an open range. We're not going to get a gap fill. So we move on to the next thing. We look at the open range. We start looking for the lunchtime consolidation, the lunch window, and we go about looking through the different zones of the day, just like that. Find another example because I've still got 2 minutes left in this video. Here, we are well below the market, well below the market. We would have expected an upside push towards that open range resolution, but that was a long distance to cover. And when the market has moved that far away, a lot of times it won't resolve the gap. Sure enough, the very first thing it did is it tried to go up there and close that gap, and it gave up very quick. After it gave up very quick, it gave us our low side pivot. There is our open range for the day. We know at that point we're not going to be closing that gap this morning. We're done. Now after the range is drawn, tested, we tested again, finally had a good clean breakout and a Busby and an opportunity to trade. So, gap resolution. Is this market going to close that gap before we get an open range? If not, and we get an open range first, the gap has been resolved. We're done. We'll start focusing on the next time zone, which would be the open range. All right, guys, that's it. I appreciate your time. I look forward to seeing you at the next video.